Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Thursday, and it's March 15th here. We got a few data here to go over, so we're just going to delve right into it. We'll start off with the weekly jobless claims that we have every week here. Last week it was reported at 230,000. It was revised a little bit lower. It was last week it was 231, and then revised it by 1,000 to 230,000. Forecast for this week was at 228,000. It came in a little under at 226,000. So pretty much kind of in line where estimates were at. So, and as we've been seeing, these are phenomenal numbers here. Jobs, as we been seeing, is that we're starting to get more labor participation, which is great, and a lot of it is, the biggest complaint that employers are having right now are finding qualified clients or employees, and and so it's a good time to get into the job market if you are not yet. So, great one here. Now, here's a kind of an interesting one here. We got the import price index. This kind of gives us an idea of what the foreign cost of goods come into the U.S. and what how much that might be, going up or down or whatnot. So January we had a pretty big spike here. It went up 0.8%, and for the month of February it went up 0.4%. So pretty high numbers here. And that is obviously due to the lower value of the dollar compared to our competitors out there. And what you may see here is obviously those costs of goods are coming in are going up. Therefore, it's going to create higher inflation over time here as well. So this is going to be an important index to kind of keep our eyes on going forward, because it could be, could lead to higher inflation later on as well. Now, the next two here are going to be manufacturing numbers. This one out of the Philadelphia Fed, which is out of Philadelphia area. We had a 25.8 in the month of February, which is a great number. And it dipped a little bit, but still a great number here at 22.3. So even though it went down a little bit, don't misunderstand. This is still a great number as well. Empire State Index. This is the New York region. So in February, it was down to 13.1. It was in like 20, and it had a pretty big sharp dip. And then in March, from January to February, but in March it rebounded to 22.5. So a pretty big increase there. So it had a sharp shift there. Last but not least, we got the home builders index. This kind of shows the optimism of where home builders are, and we had a very high number of 72. Anything above 50 is really is that measure of their optimism, and it had a slight dip at 70. But again, these are very high numbers here where we're at. So you can only maintain those very high numbers for so long, and basically it's still showing that there's a very strong demand for housing right now. So let's go over, take a look here at the headline news. Earlier, the stock market was up. Now it's kind of simmered down a little bit later morning to almost noon East Coast time. That it is more mixed now. Nasdaq kind of dipped into negative territory, but the Dow is still kind of creeping up and is kind of taking off a little bit here. Now, one of the things that the investors are getting a little concerned about is, all these tariffs and possible trade wars. And before they were optimistic, with all these expansions, with the tax credits and, for corporations, taxes and everything else. But now we're getting into a point where we're kind of upsetting they feel like we're upsetting our trade partners like China and Europe and people like that, and by placing tariffs on goods, cost of goods. So again, it's going to be interesting to see, they're concerned that it's going to, with the retaliation, that, we may not have the expansion as what we thought. So, it'll be interesting to see how everything plays out in the near future, but this is what's kind of concerning investors. Their number one concern at this point now, since inflation seems like it's going up but not overheating like they thought in January. So let's take a look at the bond market, and here's the bond market. We were touching this 25-day moving average. We were just literally just a hair above it. Closed it above it yesterday. We were up earlier today. We were trying to pull up. We are even up as maybe 6 basis points higher than where we finished yesterday. But since since the Dow's been taken out, that money's been leaving the bond market, going more into the stock market, and now it's kind of pushed us below the 25-day moving average. Now, even though this was a hair over, the problem is it wasn't really above convincingly. We were testing it going up there, but we didn't really close above it convincingly. And because of that, it wasn't really a strong. It was kind of a weak effort, so to speak. So, not really surprised. Right now, we're down about 11 basis points. Not quite enough really to have any difference in pricing as of yet. But it depends when pricings come out. But again, pricing shouldn't really be much different from what it was where we left off yesterday. Here's the 10-year Treasury. The good news is that we're still below this 10-day, its 25-day moving average, which has been a great floor of support for it. And since it's broke below that about 2 days ago, and since we're still hovering down below it. Right now we're about 2.83, so we're up a little bit for the day, but we're up about 2.83 right now, and still below this 25-day moving average. So the longer we stay underneath it, the stronger this becomes as a ceiling of resistance for us, which will kind of help put a lid on rates going up. All right, so that pretty much wraps everything up. I hope you guys have a great rest of your day here. If you guys want to get more data, just come over to Twitter. You can find me on my handle at Mike Bjork. I do post throughout the day on Twitter. Hope you enjoy the rest of your day. Look forward to see you guys tomorrow. Bye-bye.